Hey there, here's a quick note. This podcast contains general financial advice only. That means it's not specific to you, your needs, goals, or objectives, so don't act on the information until you've spoken with your financial advisor. You'll find our full disclosure, disclaimer, and link to our financial services guide in the show notes.
I have a very special guest today, and it's someone who had a profound impact on my last guest, Ben Rundle. He's currently a portfolio manager at MA Financial Group and runs the Masters Invest website on the side. He is an avid reader and is generous enough to share all his lessons and resources on his website. We're going to talk about lessons from the great investors, building mental models from reading, and the importance of psychology. Without further ado, welcome John Garrett. How are you going?
I'm great, thanks, Raymond. Thanks for the introduction, and it's a pleasure to join you on the call today.
Thank you for coming on. It's an absolute honor. So before we do get started, I want to get an understanding of how you felt when you heard Ben Rundle say you were the most influential person in his investing career.
To be honest, I was pretty blown away. I was humbled by his kind comments. I was fortunate to work with Ben some years ago when I was on the equities desk at Moelis Australia, and we worked together. Kind of talking to clients and selling ideas to them. And, he's got a lot of integrity. He's a really great guy. He himself possesses many of the traits of, the great investors. He's continuously learning. He's, kind of open-minded. And, since the time that I worked with him at Moelis Australia, he then moved on and went to the buy side where he worked at NAOS. And obviously now he started his own fund, Habra, which has had a great start in the year or so that he's been running it. So, it's always great to be able to have an ability to kind of influence people in terms of, their understanding of markets. And, it's a pleasure to see someone, a good guy to, have a successful career. And I think he's still very early in his career. And I think if we look back in 10 or 15 years time, it's going to be hugely successful. So yeah, I was humbled by his feedback.
It's always great to hear these stories. I think, mentors play a very important role in everyone's lives. So you definitely fulfill that role for him. So I'd like to dive into your personal background. I noticed on your website, which I do read every now and then, it's filled with a wealth of knowledge, mastersinvest.com. And there's a very interesting section about your bloodline, showing photos of your father and your great grandfather, and they were in the stock market space as well. Did that kind of had an influential impact on you growing up?
Well, certainly in terms of my career path, it did. As you said, my grandfather was he was actually a principal trader in the UK, and he ended up kind of just working for himself. Unfortunately, he passed away when my father was younger, so I never had the opportunity to meet him. And then my father came out to Australia and did a whole heap of different things and ended up being a stockbroker. So, but I wouldn't say it was one of those kind of early beginnings where you sit around the table and talk about stocks every day. He didn't really talk that much about the markets, but he certainly said when I was in my teens, he kind of used to tell me that if you want to be where it's at, you either want to choose the stock market or the real estate market. And I think for me, being a little bit rebellious, I probably decided to take the alternative path and study real estate. And it wasn't really until my second year studying real estate that we kind of got involved in finance and corporate finance. And I just found it endlessly fascinating. And I think from that point on, I certainly used to talk a lot to my father about the markets and, what was going on in the markets. And I kind of had the opportunity, I suppose, when I moved from Adelaide to work at UBS in Sydney, to kind of put real estate and finance together. My learnings in real estate, I studied at the Securities Institute. I did a graduate diploma in investment and finance. And so, I think it had some influence on me. And, I just remember some of the things my dad used to talk about when he talked about companies. He liked businesses that didn't spend much on their annual report and were pretty frugal. And, some of these things that, to this day are, things that, when we're looking at businesses. So I think that it had it certainly had some impact on my upbringing and my interest in the markets.
That's really great to hear. So if we move forward a little bit, so from 1996 to 2005, in your first decade of your career, as you said, you spent a lot of your time dealing in the real estate investment trust space at UBS Investment Bank, but also at that point in time, you experienced the Asian financial crisis and also the tech bubble. How was that?
Well, I think the more time you spend in markets, you kind of get to see that, the unexpected certainly happens, and crazy things can happen with prices. So I remember I was working on the dealing desk at UBS, and you'd go out for a meeting when the Asia crisis was on, and the Asian markets had opened up and had gapped down significantly, and all the stocks that you were buying before you went for your meeting and came back were 5% lower. So that was certainly an interesting time in terms of the volatility in markets. To the other extreme was the tech boom, when you just saw these businesses that were trading at kind of ridiculous multiples, and it was just one-way traffic. I remember we'd be looking at these stocks, and if anything had a .com behind its name, it was probably trading at least $1. And I remember people would recommend a stock, and you'd look at it and it'd be at 50 cents, and they'd say, oh, these guys are a mining stock, but they're getting into tech. You'd sit there and say, well, why is the stock only 50 cents? Anything that was related to tech should be, at least $1, $2. So it was unbelievable. It was unbelievable times, but it also unwound ridiculously fast as well. So, that was a good experience. I mean, both of those were the extremes of fear and greed in markets. And, my view is that human nature doesn't change. And, if you look through history, and I'm sure if we go, into the future, we're going to see that, that human emotion have an impact on markets going forward. So, I have been fortunate to have seen a number of cycles and a number of kind of crazy times and things that you'd never expect to happen in markets.
Mm. You showed me a really interesting graph. I think it was in Ned Davis's chart.
Yeah, that was one of my favourite charts, I suppose, showing the extremity of markets. Ned Davis, I think he only stopped writing his newsletter a year or two ago, but he would write a newsletter about the markets, and he had this table which showed, it kind of showed the extremity of the time. It had on one side of the table, it had all the companies you could buy that would add up to a certain figure, and they were all the names that you would have heard of, things like Ford, Merrill Lynch, Caterpillar.
I think Apple was there as well.
Yeah, Apple was there, FedEx, JP Morgan. I mean, huge businesses today.
Yeah.
And you could have bought all of those businesses combined, or you could have bought Cisco. And those businesses were trading on about 14 or 15, the combined entity was trading on 14 or 15 times earnings and about 1 time sales. You compared that to Cisco trading on 213 times earnings or 36 times sales. So, I mean, it was a very interesting time because, tech obviously had done very well. I'm not sure even to this day that Cisco's got back to, it may have, if it has, it would have only been in the last few years, got back to the levels that it got to in the tech boom. But, it was just another example that, if you chase things and pay the wrong prices for businesses, then A, you can lose a lot of money, or B, it's going to take you a lot of time back to break even. So, yeah, that was certainly, and when people talk about, the tech boom over the last few years and the FANG stocks and they get in the habit of comparing it and saying, look, it's like the tech boom of 2000, a lot of the FANG stocks were, still trading on, outside of Amazon. These businesses are, some of these businesses are on 20 or 30 times earnings. I mean, it's just not it's not the extremity that we saw back in 2000.
Mm-hmm. It's very interesting because I think other two notable examples, I think from that time that I think a lot of people currently talk about, there might be a bit of survivorship bias leaning towards talking about these two companies being Amazon and Microsoft. I think you would have had to wait a really long time. I think for Amazon, it's a different story compared to Microsoft. But what were your thoughts about on those two businesses around that time?
Well, I mean, kind of from memory, Amazon was, certainly was the poster child of the internet at the time. But, they didn't have AWS. I don't think AWS would have even been invented back in the tech boom. I do remember there was a broker report on Amazon at the time, and from memory, they were just a bookseller. They hadn't morphed into being a seller of other people's products and selling all sorts of different things. They really were focused on books. And I remember reading an analyst report out of the US, and they had compound growth at whatever the number was. It was a big number, and by the end of it, Amazon was going to be selling more books than every single bookstore in the world was currently selling, which I thought was, unless all of a sudden people decide that they need to own more books, which is unlikely, was probably not going to happen. So I don't really recall too much about Microsoft. Microsoft's obviously, they did go, for a long time. Microsoft certainly wasn't the darling that people have perceived it to be in the last 5 years. They've really kind of changed their business, have become a SaaS business, and have got involved with Azure and the cloud and so forth. But yeah, I mean, they were big businesses on big multiples, and with the benefit of hindsight, certainly, for most of the businesses, they've, you've lost money. If you've been able to hold on to Microsoft and Amazon, you've been amply rewarded. But I'm not sure owning Amazon at that point of time would have, you would have been able to ascertain that, it was going to get into cloud computing and it was going to be some of the success it is today. So, it's always easier with hindsight.
Yeah, definitely. So after your first decade, so you went to sell side, so hedge fund advisory. So you spent a good decade there, 2007 to 2018. And so when we chatted yesterday, you talked about a lot of your work involving providing live model portfolios for clients. That's very interesting. I would just provide our listeners with an overview of what you did there.
Yeah, well, I moved to the hedge fund advisory business in probably the early 2007. So, the market was still very strong. There was a bonanza with M&A. Private equity was, kind of bidding for everything. I mean, the beauty of the hedge fund advisory business and hedge funds generally is, their toolkit their toolkit is certainly much broader than, your typical long-only investor. And some of what the accounts do, some of the larger hedge funds, they try to work out, I suppose, where there's pockets of alpha within the marketplace. So rather than paying a broker for, all the analysts' research ideas that they've come up with and their research reports, they will ask their broker clients to effectively manage, kind of model portfolios for them. And, nowadays those model portfolios are live, they're updated every day. And then they can monitor to see whether, this person is good at picking stocks. Does he add value? Maybe there's some value in people that, consistently wrong. And so rather than paying, commission as, that person wrote that report, will pay for that, they basically pay it on the profitability of that portfolio, model portfolio. And these are big companies like, Marshall Wace is a multi-billion-dollar asset manager out of the UK, Citadel, which, many of your listeners would have heard about. It's a big hedge fund. And so what you did as a broker, as well as your job of, advising clients in how to manage their portfolios, is you actually manage these model portfolios. And clients would have different constraints. So they might say, we want you to be, within the bounds of plus or minus 20% net long or net short. You can't have more than X number of stocks. But what that gave you an opportunity to do was really to manage your portfolio. And, the idea is you couldn't just kind of come up with ideas and have a buy recommendation. It wouldn't work. You just move on to something else because, if you wanted to get paid commission, the portfolios had to perform. So I think that was it was an interesting, you ended up owning I think you ended up owning your ideas and having more conviction, in terms of the ideas, because at the end of the day, that was how, in a large part, that was how those clients were paying you. So going through that, and I started that in probably about 2009, and I did that for the better part of the next 10 years, running model portfolios for some of the biggest hedge funds in the world. It gave you an idea about how do you build a portfolio that is going to perform in different environments. How do you think about position sizing? How do you think about correlation? How do you think about liquidity, and I think the skill set of building and running a portfolio is a different skill set than picking stocks. It's not just like let's go and analyze 8 companies and just go and buy all of them. I mean, obviously, different clients have different criteria and different tolerances for volatility, but that was a really good. I found it a really useful process in terms of getting better at how do you manage positions, what happens when they go down, do you add to them, do you cut them, etc. I mean, it's not the same as managing money. Ultimately, at the end of the day, it's still a paper portfolio, and I think that that's one of the biggest challenges in investing is actually the psychological challenge. Like when the market falls 15 or 20% or 30%, how are you going to emotionally cope with that? But certainly, I learned a lot through that process.
Mm. It seems like it's probably the second best way to actually operate a fund, essentially.
Well, I think it's, the people that run these funds, they've obviously got a lot of inputs. So some of them use them in different ways. So some of them will use, more quantitative analysis. There's a fund called Two Sigma that runs billions of dollars, a quant fund, and they're looking for signals from people. So they want to know, I'm guessing all of a sudden everyone's moving into tech or everyone's selling interest rate sensitive stocks. And there's other funds that use it more for, individual stock ideas and for stock picking. I mean, it's not a new concept. I remember reading about the first hedge fund that was ever set up was actually run by an Australian guy that set up the first hedge fund, and this would have been probably 50 or 60 years ago. And he set up that process where instead of just asking brokers for their research, he actually tracked to see whose research was adding value as opposed to who wasn't, and rewarding his brokers for ideas that actually added value.
It's very interesting because I think, as you alluded to, there's a different kind of pressure in running this model portfolio for clients, and then you're compared to operating a fund where you have probably a lot more pressure, but it's a different kind of pressure.
I think I spent most of my career on the sell side, so advising clients, long only funds and long only institutional accounts and hedge funds about kind of managing portfolios and ideas for their portfolios, analysing stocks, and then I moved to the buy side about 3 years ago, where you actually have to put that, you kind of have to put that, hopefully those learnings into practice. And I do think it's easier to sit on the sell side and come up with ideas when, there's no consequences really. You might come up with an idea and hopefully it works, but there's plenty of ideas that don't work. And if you don't have skin in the game, they probably hurt less when they're wrong.
Yeah, continuing on the topic of pressure, I think during that time, we can't not talk about the great financial crisis. So you talked about how history often doesn't repeat itself, but often rhymes, as quoted by Mark Twain. You also read House of Morgan, which also covered the 1920s, the Great Depression, and that kind of reflects that quote by Mark Twain. What was going through your mind during the GFC?
It's a great quote that history rhymes. It's never the same, but you can certainly take lessons out of the markets and out of history. And over the last 2 decades, I've spent a reasonable amount of time studying the history of markets and the Great Depression and the Nifty 50, and to kind of understand that markets really teaches you that markets do some strange things from time to time. But I think we were pretty fortunate that. I remember at the time I was reading about an investor, or a trader, I should say, called Jesse Livermore. I just happened to be reading about, what he was talking about I think it was the 1907 crash. He was just talking about the credit markets had completely clamped up, and the markets just continued to rally. And it took, some time for the market to work out that there was a real problem that was happening. And, in late 2007, that's exactly what happened. Was that the credit markets completely shut. in the stock market, which it has a habit of doing that, ignores it for some time. So, if you kind of look back in the history of the global financial crisis, Northern Rock, which was a mortgage lender, one of the big mortgage lenders in the UK, basically had to get government support. It needed to get bailed out. They couldn't access the credit markets. And the stock market probably went on for the next month to hit, to continue to hit record highs until it all came undone. And at the time, I was also reading a book called The House of Morgan, which was about the history of JP Morgan. And there was a few chapters in there. From memory, one of them was called the Depression, and it was just uncanny, the type of things that that I was seeing that were in that book. And that book was written. It was a book by Ron Chernow. It was written in, I think, 1990. So it was written, obviously before the financial crisis. And he was talking about what created the problems in the 1920s. And you'd had this boom period. You'd had easy credit. Interest rates were almost zero. There was massive M&A going on, which is exactly what happened in late 2007. And there was investment banks in the 1920s that were packaging up bonds from, I think, from places like Portugal, and they were selling them through their affiliates to people that had no idea what they were buying. And I was reading this thinking, wow, this could be written exactly, what we're seeing right now, where the investment banks have packaged up their, subprime debt and selling it to people that had no idea. Interest rates were very low. There was an M&A bonanza. And at the time, there was, banks were getting in trouble. And, so I think it was fortunate that, I just happened to be kind of getting into, that part of market history. So I was on the hedge fund advisory desk, and I think, I don't think we put out a recommendation for quite a while. We were pretty bearish. In some part, I think that's luck, but certainly, and I never expected it was going to be as bad as what it was. But I think by studying history, you can kind of see those parallels. And while we're not really that focused on macro, I certainly keep an eye on it. That when there's what I would say, what look to be asymmetric type situations in markets, it's time for caution.
I think the saying where people you'll learn the most when you get thrown into the deep end. I think that decade of experience would have set you up very well for your foray into the buy side, which happened in 2018 when you opened up your first small caps fund that has a maximum market cap of $500 million.
I suppose the concern I had at the time, when in the back of your mind, you're always thinking, well, you think you've got an okay handle on markets. You've been through a few cycles, but how are you going to cope when there's kind of volatility? And I think we're all driven by emotion, which emotion overrules. Unfortunately, it overrules our rational side. So it was interesting timing, because I started running Moelis Australia, had a small cap portfolio that had been running probably for a couple of years, 2 or 3 years, and I had the opportunity to kind of move across and become the portfolio manager of that portfolio. And in about the first 2 seconds of sitting in the chair, the S&P 500 collapsed about 20%, which I think was actually the worst December in about 100 years. So I started in October, and the market got absolutely thumped. So that's an interesting kind of time to, when you're managing money, is, you are going to be tested by markets. Markets, unfortunately, while over the very long term, they tend to go, up and to the right. In the intervening periods, you can get, a significant amount of volatility. So how do you kind of manage the emotional side of investing? I think it's pretty important. And then that was 2018, and then fast forward to 2020, and we had COVID. I'm sure that those two events in a statistical sense would be supposed to happen probably one in every 10,000 years or something stupid. So it's been a pretty volatile last couple of years, but I think it's never easy in markets. You can look back and, while you say markets have done 10% over the long term, you've had to cop a fair bit of volatility in the intervening period.
And you also recently, I think last year in August, you opened your Opportunities Fund, which is index and also market cap agnostic.
the larger fund that we run, which is has now got about 600 million in it, the mandate, which is part of a SIV program, is it's a little bit restricted. We can't invest when we start in any stock above $500 million, and there's a finite number, I think, of really high quality businesses that fit into that category. So we thought there was an opportunity to build a new portfolio or a new product where we could invest in small companies, and I suppose use the IP or intellectual property that we've developed in those smaller companies, but we can also complement that with owning some larger companies in Australia and just cherry picking what we think are the best businesses that we think over the long term are going to deliver attractive returns, and those businesses are going to be probably less volatile than some of the smaller cap stocks. But we did the numbers, we did a bit of research into it, and we found that if you look at the ASX 50, so the top 50 stocks in Australia over the last 10 or 20 years, the chances of one of those stocks doubling in a year, there's about 3% of if you bought a basket of those stocks over the last 20 years, the 3% of those stocks will have doubled. And that makes sense because the ASX 200, it's kind of, or ASX 50, it's an interesting index. It's very highly weighted to resources and to banks, and banks and financials. Financials probably make up about 30% of the index. Resources probably make up 20. So you've got 50% of your index exposure in those two sectors. Interestingly, tech is probably 4% of the market, and you kind of contrast that to, say, the US market, the S&P 500, where tech would be 30% of their index. Resources are probably between 5 and probably 5%, and financials are probably, I'm guessing here, 10 or 15%. So the Australian market is far, far less diversified, far less exposure to technology. And so, you think about our banks and our resources, these are big businesses. As you get larger, you start to hit, the law of large numbers. It's much harder to double what, if you're a big business. Whereas if you can go down into the smaller end of the market, and we looked at the market cap range of 200 to 400 million, if you invest in that sector of the market, you've got about a 15% chance. 15% of those stocks will double over any 1 year period. So what we try to do with this portfolio is we try to take advantage of that. So we go and cherry pick what we think are the best businesses. We don't have to, if we don't like resources or banks, we don't have to, go and invest in those. We're really looking for very, very high quality businesses. And then we're looking to, complement the portfolio with some smaller businesses, which we think have got very long runways for growth, that could deliver, those kind of 100% plus type returns. So that was the thinking about, kind of building this portfolio. The bigger stocks give you ballast. The smaller names give you the ability to, to hopefully make, some significant gains. Overall, the overall result being that, over the medium to longer term, I think the portfolio will outperform, a broader market index.
I think I really love this approach of where you're using the small cap funds. It's essentially like an academy in a sports team where you're trying to find the next superstars, the youngsters. And then once you've monitored them over a period of time, then you kind of get more conviction of who's going to become an absolute superstar in the team. And then you essentially pick those for your opportunities funds, if I'm correct in saying that.
Yeah, that's a great, I hadn't thought about that analogy before, but that's a great analogy to think about. You're picking your younger players, your rookie players that are going to go on, and certainly, absolutely, that's what we're trying to achieve. But we're not waiting for those in the opportunities fund. We're not waiting for those businesses to become bigger businesses. Like, we can own them in the fund at the moment, and the fund's just over $100 million. So we can actually, it's got the capacity for these businesses, and they have actually made a real, a real impact. I was looking at the numbers on the opportunities fund the other day, and I think of the 7 largest contributors to performance over the first year. Of the 7, 6 of them more than doubled. And they were those smaller names, and a few of them had some, interesting characteristics, which, we think means that they can go on and, be much bigger businesses. And those businesses tend to be, probably less well followed. They're smaller, so they don't have as much, as many people following them. They're probably not in any indexes, but the characteristics that make these businesses great, whether you're a $100 million business or a $200 million business, the things that we're looking for in those businesses are no different to the bigger businesses. Obviously, in many cases, the bigger businesses have been around longer. They may have been stress tested by different, more challenging cycles. But we really are looking for the same characteristics, and we're hoping that our style of investing is to try and generate our returns out of the underlying businesses that we own. So we're not trying to buy a business on 10 times and sell it on 12 times, because that's where the index is on. We're trying to find businesses that can grow and have got long runways of growth. So yeah, I like the analogy.
So we chatted a little about valuation, and trying to find great businesses, they often don't come cheap. But I think one insight that really resonated with me and was your focus on the destination when you think about valuation. Could you unpack this more for our listeners?
I think when I started, like a lot of investors, and what you're taught in, maybe in business school is, like you're very focused on numbers and building valuation and, kind of simple heuristics, if you like. So buy a stock on a PE, the stock on a PE of 10 is cheaper than a stock on a PE of 20 or 30. I kind of, over the years, I've morphed where I probably erred on the side of, wanting to buy things on low PE multiples, to now at the point where I recognize that, you can have businesses on high PE multiples, that can still be cheap. One of my favorite investors is a guy called Nick Sleep. And he wrote about, and it's a very extreme example, but he wrote about Walmart, and he said in 1972, Walmart, you could have paid 150 times the prevailing share price at the time, which would have been a PE of 1,500%. You still would have earned a 10% return, until, holding that until, I think he wrote it maybe 3 or 4 years ago. Maybe a bit longer, maybe 5 years ago. So imagine, paying a PE multiple of 1,500 times. And he then said, if, even 10 years later, you could have paid a PE multiple of 200 times. And so I suppose that, what does that tell you? It tells you that, a simple PE metric, at times can be misleading. And, as humans, we love to simplify things and, dumb it down and put one, I read a thing from a guy from the Santa Fe Institute, and he said humans love just like single numbers, and if it's on a PE of 15, it's okay. If it's 25, it's expensive. If it's 10, it's cheap. And he made the point. He said, well, you wouldn't go and fly your plane with one metric, right, that you're relying on. And I think as investors, it's important to kind of not get too caught up in that whole, what's the PE, what's the EV to EBITDA. And so really, what we're thinking about is, and you kind of mentioned, is we're thinking about like, where is the destination for this business? So if we think the business is, we kind of look out 3 to 5 years, and we're looking at like, how big could this business be? What are the competitive advantages that this business has that's going to allow it to grow and become a much bigger business? And then, provided the PE multiple doesn't get extreme. And when I say that, I really mean, provided we still think the returns that we're going to generate from paying the price today, by the time it gets to our estimate of the destination, if those returns still remain attractive, we're going to continue to hold on to the business, and we're going to tolerate a level of short-term, what I would refer to as short-term overvaluation. If it gets extreme, we're probably going to divest. I mean, a good example of that was, we were an investor in Australian Ethical Funds, which is a fund manager. We thought it was a great business. We had I suppose a somewhat differentiated view, or it's now a consensus view on, ethical investing was at an inflection point and was going to take off. We liked the business. It had some great characteristics. It had a scale economic shared model where they shared their fees as they grew. They shared their fees with their customers. Most businesses, as a generalisation, when they can save money, they tend to try and keep it. And they gave a lot of money to charity. And we think investing in general, if you're going to buy businesses, they have to win in the ecosystem over the long term. So we bought that and we owned the stock, and the stock did very well. And I think there was a lot of inflows going into ESG funds, and the stock probably got into some ESG indexes, and index funds don't care about what price they pay. No price is too high for an index fund to pay for a stock. If it's in the index and it's on, pick a number, they're going to pay it. It's the same when they're going out. Like no multiples too low for an index fund to sell, because if it's out of the index, they've got to sell it regardless. If it's in the index, they've got to buy it. And if a lot of money is going into that, that type of strategy, then you can get extreme results. So I think the stock more recently traded on a PE of 160 times. Now, most asset managers trade on PEs of 10 to 25 times. We kind of got to the point where we think it's a great business. We think it's going to continue to grow, but it just got hard to justify. We think owning it here and the type of growth rate, it's just the risk and reward wasn't there. So we ended up, kind of selling our position in that. But, as a generalization, we tend to try to hold on to these businesses, provided that the longer term destination is intact. And remember, another saying I like is good things happen to good businesses. And, in my career investing, I've seen that, kind of so many times, that the business does something, they buy a business, it's highly accretive, or they go past an inflection point, or, they win some new customers. And the challenge is with great businesses is it's very hard psychologically. And even Buffett would say this himself. If you've bought a stock at $1 and it goes to $2 and you sell it and you think you're a hero, and then it trades up at $3, it's very hard psychologically to buy back in, probably because you don't like to admit that you made a mistake in the first place by selling it. So as a generalization, we're very focused on the destination. Notwithstanding, we understand that there's a whole heap of potential destinations, and it's kind of based on probabilities. But if we think the destination's intact, and this is a kind of philosophy, Nick Sleep, talks a lot about, is that stick with it. And as people want to see active behaviour, but the best, if you think about investing in the last 10 or 20 years, the best thing that you could have done would just be buy Facebook, buy Google, buy Amazon, and do nothing else, right? Don't trade them around, don't sell them, just own them. So that's certainly one of our philosophies.
I wanted to touch upon your comment about working out the risk reward payoff, because I guess talking about these companies, I think there's a lot of dialogue about the pricey valuations and the highs that these companies are going through. What are a few ways that you use to work out that risk reward payoff? Do you kind of back it out, like you do a bit of reverse engineering?
The way we tend to think about it is we think about it in each of the individual businesses that we own. So if I think about say a business we own is and we've owned it for the last 3 years, is a business called Johns Lyng. Stock's probably gone up 3 or 4 times since we've owned it. And so if you look at that business today and you look at the multiple that it trades on, it's probably expensive. Well, it's not probably on a short-term PE multiple. Optically, the business looks expensive. That's an example of good things happening to good businesses. Recently, they bought a business in the US, which was highly accretive and gives them a lead kind of into that market. But if we think about that business, we think about, at the moment they do repair work for insurers in Australia. They've just moved into the strata business, so they've been buying up kind of strata operators, and they've made their first acquisition at the end of last year. into the US. And so if we think about that business, we think about, well, where could that business be? What are the things that make it competitive? Are they sustainable? Why is it winning? Can it do what it's done in Australia, in the US? And it's not assured, but we think there's a high probability it will be successful. If we think about some of these businesses, and I think of, some of the numbers the names we own, we like businesses where they have this, and this tends to happen a little bit more with smaller businesses, is they have this kind of tangential opportunity where they can incubate and cultivate a business that might be able to be the same size as their existing business within 5 years. So we love those opportunities where you've got a great management team, they've got a track record of success. And so, we'd look at that and we'd think, okay, well, maybe we're paying, I don't know, whatever the multiple is, 20 times for that business today. We think in 5 years' time, they can have another business that could be exactly the same size as their existing business. And we think, for various reasons about, their ability to deploy capital, that we think the business can compound at 15, the underlying business could do, 10 or 15%. If it was a retailer, we might be looking at how many stores have they got now? How many stores do we think they've got in the future? Those type of things. And we get to, where we think the destination is. We try not to be aggressive in, we don't sit there and say we're going to buy the stock on a PE today of 15 and we think in 5 years it'll be on 20 times. We're more than likely to go, we think it's on 15, maybe it can hold it, maybe it's 12. But the power of compounding is so extreme that, if you've got a business that can grow at high rates of return, then, what looks to be an optically high PE ratio in the short term is, when you look back in, 5 or 10 years is, it's going to be cheap. So I think that's how we try to frame the destination. If it was a retailer, I think our starting point would be, how big is it now? What could it be? It's different for, every business, but we tend to focus on businesses where we think we can underwrite the future. So we're not, I never say never on anything, but we're not really into commodity companies. We're not into biotech because they tend to be too binomial. We're trying to be in businesses where we think we can underwrite where the business is going to be and have confidence because of the competitive advantages that we understand about that business, be it, and a lot of those will be qualitative, culture, people, all of those type of things. Hope that kind of answers the question.
Yeah, it does, definitely does. So I just wanted to take a step back. So you spend a lot of time reading. You have a voracious appetite for books. You're evidently very busy being a portfolio manager. Is there anything outside of work that kind of takes your mind off investing?
I do like to, I spend my spare time and my hobby, my hobby is, it's kind of it is reading. Like I enjoy reading and I read broadly. So I tend to read about, more, and I'll go down different rabbit holes about what I might be interested at the time. So over the last 10 years, I've spent a lot of time reading about great businesses. Yeah, but I read, I've been reading about the Pentagon and skunk works and, crazy things like honeybees and biomimicry and, all sorts of stuff. So I do spend a lot of time reading, and I love it when, an investor that I look up to might, say, I've just read this book, it's great. And so, I'll tend to, buy the book and, spend a lot of time reading. I do spend a lot of time, I try to spend a lot of time with my kids and with my family. And, I really value that. I have been trying to, kind of get more into my fitness, which I think's, it is important. It's kind of, COVID's made it a little bit challenging. I've probably watched a lot of Netflix, so their numbers will probably be pretty good. And, 2022, I think for me is I probably need to get more. If you ask my partner, she would say you need to get a little bit more balance in your life. So I love the markets. I really enjoy learning. I love reading. I think, to be successful, that's kind of, you got to keep learning, and, there's just so much we don't know. So
on the topic of reading, so you spend, I think, and you still do until this day, you studied the great investors, and I think myself in the investing community have also come across, the greats as well. But you really take that extra leap and extra step in covering around 59 great investors to date on your website, which is phenomenal. And they all have different investing trade styles. You said a couple of them are more macro focused, some trading focused, and some are just purely long only. Having covered so many great investors, which of these great investors really resonated with you?
I think all of the and these investors have got track records of success. And so, for me, it's like trying to unpack, like, what are the characteristics? What are the qualities of those investors? Like, what do they do that has made them successful? So, while nowadays I probably spend less time studying those, but, studying them, I still follow, like I love, listening what Stanley Druckenmiller's, how he's thinking about the world. So, I don't follow, I probably follow, I'm spend more of my time now studying other things outside of the great investors, but I definitely follow and read all of their letters. And then, in time you come across new investors that, teach you things that, you hadn't thought about. So whether it was, I mentioned Nick Sleep and, the way he looked at the world, whether it was Marathon Asset Management and how they think about the capital cycle. And all investors have different, they all have different styles. Like, there's no, I don't think there's any two investors that are alike. But what I would say is that, they all have these, you can find these common characteristics. So, I've studied Jim Simons, who's run Renaissance Technologies, which is probably the most successful fund there's ever been. I think his returns were, 40% a year or 45% a year, something ridiculous over, 25 years. He's kind of somewhat constrained in the amount of capital that they can run. But he was a code cracker for the US government, and I don't think he started his fund until he was about 46. Ed Thorpe's another guy that was an MIT professor, wrote a book called Beat the Dealer, how to win in blackjack. And then you have, so you have quant, I put them into quant category. Then you have traders like, Soros and Druckenmiller who work for him, and Paul Tudor Jones. And then probably the guys that, resonate with me more, the Buffetts, Munger, Ackray, Terry Smith. I mean, these are investors that the average investor can mimic their investing style and can execute their investing style. I don't think anyone, I think it's a rare person that can do what Druckenmiller or George Soros does, and certainly probably rarer still. I mean, definitely rarer still that that you can do what Jim Simons or Ed Thorpe did. I mean, those guys are mathematical geniuses. So that maybe that's why I've ended up with the latter guy in terms of. For the average investor, you can find great businesses, high quality businesses. You can look for those characteristics. It's going to be easier for, you don't have to be a genius to be that type of investor. But notwithstanding that, if you look at investors generally, and on the website there's about 100 tutorials, and all they simply are is subjects with quotes from the great investors, and whether you're looking at, preserving capital or being humble or continuous learning and evolving, those quotes aren't for a particular type of investor. They're for all of those investors. So whether you're a quant, whether you're a trader, things like, as I say, preserving capital, being humble, being open-minded, being curious, having an edge, whether you're trading, whether you're a long-term investor. As an investor, you have to have an edge. You have to understand what you're invested in. You have to do things where you've got, as Buffett would call it, your circle of competence. You can't get emotional. You can't follow the crowd. You've got to I think you've got to understand the markets. You've got to understand yourself. You have to work hard, because the people that you're competing against, they love it. And if obviously if someone loves something, they're going to be, if you love playing tennis, you're going to be better at someone that doesn't like it. So the thing I've got out of studying those individuals is that there are these common characteristics that they portray. And then it's interesting when you go and then study great businesses, you suddenly find like, wow, there's all these characteristics of great CEOs and great businesses as well. So I think, and if I look at any of the investors I've learned, I wouldn't say there's an investor I haven't learned something from. Maybe it's a little, kind of mental model about, a situation in markets, or how non-linearity works, or how this, from Marathon, it would be how the supply cycle works, or, Nick Sleep was a big proponent of scale economic shared. Yeah, so I think you can learn from, and the great thing, I mean, Buffett and Munger, I think are, probably the two greatest investors over the last couple of hundred years. And, what's so great about them is they just share everything. They share their knowledge. It's, you can read all the Berkshire letters, and a couple of years ago, they put all of the meetings from Berkshire are now online with transcripts. I mean, those two guys have seen everything. I mean, they've been through every market cycle. They've been pitched every investment, under the sun. They've managed businesses. They've owned businesses. There's just so much you can learn from, all different types of, of people. But you've got to put the work in.
You've covered a lot of great investors, and this is going to be a tough question, but who do you think resembles yourself the most out of all these great investors?
Well, I think it's, I think these guys, I've been running the fund for 3 years. So I think all of them have got track records, longer track records, and, very attractive returns. So, maybe it's a question in terms of, 10 years, but, in terms of performance, I suppose. But in terms of style, I think a lot of investors, that I've studied, they start off very focused on valuation and very focused on, PE multiples probably, and, building discounted cash flows, and, on the quantitative things, and they're focused on, like on the macro, and, maybe charting, and, things like that. And I think over time, maybe they're focused on shorting stocks. But I think over time, the investors that I resonate more with are those that, are focused on quality, on the quality businesses, and generating returns, from the underlying businesses. Now, Buffett says there's more than one way to investment heaven. There's plenty of ways to skin a cat. So I'm not saying, the way that I do it is, by any means, the best way. But I think, I probably resonate with, those type of investors. So I listened to a podcast the other day from a guy, Third Point, one of the, most successful hedge funds in America. And he was the co-CIO who's now left. And he said that, he used to be really hung up on, kind of valuation, and, focused on very focused on investors, and very focused on macroeconomics. And now he just reads about great businesses, finding very high quality businesses. And I think that's, the transition that, that I've made. Some people, I think, make it very early in their career, but I think it's a long-term evolution. So, guys like, that I think in that category that are exceptional, people like Buffett and Munger at the top of the list, and Chuck Acrae, Terry Smith from Fundsmith, the guys from WCM, Nick Sleep, these guys that are focused on buying high quality businesses, having patience. That's the type of, investor I think that I more reflect in the latter part of my career.
I find your statement about a lot of investors going through that transition from being quantitative based and numbers based, building DCS, and then more to the qualitative aspect. I think I speak for myself, where I'm trying to build models and trying to work out the value of a business. I think humans are wired in a way to gain comfort from having a number, and because it provides you with that safety net in a way.
We think the numbers are important, obviously, because, they reflect the underlying business. They are backward looking though. So, the numbers that come out of a business are all backward looking. They're not going to tell you, kind of what's going to happen in the future. They also don't tell you everything about the business. They're like an abstraction, I suppose. And they're a function of the qualitative factors of the business. So, what is the business model? What is its culture? What is its relationships with its customers? Are its people, empowered? What are the competitive advantages? So the numbers come from those from those attributes. So, we tend to think more about, when we're thinking about investing, I don't think anyone sits down, builds a spreadsheet and says, oh, wow, like my DCF's $2.20 and the stock's trading at $1.70, it's a buy. I mean, I just don't think that's what, and I agree with you, people, they kind of get anchored on spreadsheets. And one of the problems with spreadsheets is you've got to fill in a lot of, if you've got a detailed spreadsheet, you've got to fill in a lot of cells. And I think some people spend a lot of time trying to fill those cells in, as opposed to standing back and thinking about, the business in a more holistic sense and understanding that what is the true DNA that is behind this business. And so to me, the simpler the model, the better. So we don't build DCF, we tend not to build DCF models and spit out, numbers, because I don't think it can be that precise. So, if we build a model, it will be, more than likely we'll look back over, I'll go back over 5 years and read everything that the company has said, and I might fill out a spreadsheet with, what the key revenue lines have done and costs and so forth, to give me some understanding and how much capital have they raised any capital, or has the business, we love businesses that have, one of the businesses we own, I think they had earnings in 2014, the year before they listed, of 7 cents. Last year they did, I think, 19 cents. Haven't raised one share. Founders own 50% of the company, never sold a share. They're in retail. The number of stores has probably gone up 30%. They pay dividends through, I'd much rather go and kind of do that analysis and see, okay, well, where's the company been deploying their capital? What's the share count done? How's the revenue line grown? Read about what they said they were going to do versus what they were going to do. Those type of kind of more qualitative things. And as I think you said, you mentioned before, the longer you own the business, I think the longer that you own these businesses, the more comfort that you can get. I mean, you can find out more good stuff, but also more bad stuff. But, you can see how management operate in different environments, how they prioritize things. To me, that's far more valuable in understanding the DNA, because, and one reason was, business results aren't linear. Like, businesses hit, that's like anything, like it's not always going to be good. So there's going to be bad, you're going to hit some rough patches, right? But if you understand, and, I said before, you have to understand any type of investing, but if you understand what you own and you hit a bad patch, you're more likely to hold on. It's when you're fearful and you don't understand that you look to others to what to do. And, in times of chaos and crisis, people just run for the exits, and then people think that the price carries news and you get stopped out of stocks at the wrong time. But if you can understand the business and you can understand the destination, then you can tolerate, in my mind, a lot of volatility. It's not to say that so we're far more focused on, that type of thing than sitting there building a spreadsheet. I mean, I used to do quite a bit of reverse DCF. So instead of building a DCF, I'd kind of back solve, the company's done 20% a year for the last 10 years at the current price. I'm going to put in, I don't know, 5. The current price is only implying that it's going to do 5% for the next 10 years. Terminal PEs, this discount rate's 10%. Like, we used to do a bit of that, but most of our time now is spent, what I would say, thinking about the business model, having a real understanding of what the DNA is in the business, what makes the business successful, what's going to help it achieve its destination, as opposed to, I just don't think there's an edge in spreadsheets. I just haven't seen anyone, and I've studied a lot of great investors, and they never talk about their spreadsheet models, or I've got a 30,000 line spreadsheet model. In fact, the more information you have, in some ways it can inhibit. You've got to focus on the core things. And if you spend your whole time trying to build a detailed spreadsheet, I think there's more. I think there's more important things, for us anyway, that have, we've certainly been more successful understanding the real characteristics of what make a business great than building more detailed models.
We also talked about, I think, a very relevant concept of finding companies that are able to fight the fade or beat the fade. So we went through an example where I usually model a business using a DCF, and then over time, maybe 5-6 years, you have strong growth rates, but then naturally it kind of deteriorates or fades away over a longer period of time. But I wanted to talk about it in a sense that you highlight the importance of finding companies that are able to do the contrary.
Yeah, it's kind of when you study, and we did talk about a little bit when you study business school. Business school, and they teach you how to build, DCFs, and they're good things to teach because they're good things to mark and test people on. And your typical lesson on doing a DCF will be, even if you think the business has got a high growth rate, and it makes sense because capitalism's brutal, and most businesses can't grow at high rates of return over long periods of time. Think about the top 20 stocks in the S&P 500 130 years ago. Probably not many of them will be in that. Maybe 50 years ago, they're not going to be in that category today, right? So, so you're taught to, and the future's uncertain. So you're taught to, have a high growth rate in the next, 3 to 5 years, and then, if it's growing at 20 or 15 or 20%, then maybe you fade it down to 7, and then you have a terminal rate of 3%. Where the real opportunity, or where great opportunities lie, is where that doesn't fade, that growth rate remains, high for a longer period of time. And the reason that for that, the impact is just the power of compounding. Small percentage changes, over long periods of time have a phenomenal impact in terms of where you end up and the value. So even 2 or 3 percentage points over a long period of time, with two numbers compounded, have a material, like huge, to the extent I think most people, even in the markets, don't kind of understand. I mean, humans think that we don't think in exponential terms, we think kind of in linear terms. So it's hard for people to kind of get their head around that. So that's the first point. So imagine if instead of the business growing at, fading away, it can sustain high rates of return. The challenge is that few businesses can do that. As I said, history is kind of littered with businesses that people thought were going to grow at 10 or 15% for long periods of time, and that just doesn't happen. And obviously in bull markets, people think that businesses grow. It's just the nature of markets. When everything's up and bullish, you think that your business will do better, and when things are down, you don't. But there are some, there's some business models and things that certainly contribute to businesses being able to achieve high rates of return that can, what's sometimes called defy the fade. And, those businesses almost always are significantly mispriced just because of that power of compounding. I mean, think back to that Walmart example where you could have paid a PE of 1,500 times. I mean, it's ridiculous, and it's an extreme example, but, it makes the point that, the PE at the time is not relevant. And if you were to sit there at Walmart at that time, I'm sure, everyone that built a spreadsheet model would have had, growing at whatever the number was, 20% a year, and then fading, and that just didn't happen. But you need to have a bit, there needs to be some characteristic. And, I wrote a piece called Fight the Fade. And the 4 things that, I talked about, one was scale economics shared as a business model, where, we talked a little bit about it before, but where you have a business that shares its scale as it grows. A great example is Costco. As they get bigger, they get more, they get economies of scale, and rather than keep those, they pass them along to their customer. Audi's another example. Geico, Warren Buffett's, Geico. This business model has been around for a long period of time, but most businesses, when they get bigger, kind of get less profitable. But if you've got a business that, is a scale economics business, as it gets bigger, the moat gets wider because you're getting more economies, you're sharing those with your customer, which means that the customer reciprocates. So in the case of Costco, you get bigger, you get scale benefits, you reduce your prices, customers reciprocate, they go and spend more, means you've got more sales, means you can get more economies of scale. And so as the business gets bigger, it gets more powerful. So, the moat gets wider, and that's what you always want in a business, is you want a moat that's, preferably growing. And so as that business grows, it gets, obviously it gets to a finite point, but, for those businesses can grow at very high rates of return for very long periods of time. So that's one model that we like, is scale economic shared. Another model with a guy called Brian Arthur wrote a piece in 1996 called Increasing Returns, and I think something like the new business and the new nature of business. And he recognized that businesses historically were subject to decreasing returns. So If you have a retail, a retailer, and you've got a lot of stores, and then you set up your next store, it's probably, as you do more and more, the locations aren't as good. It's harder to get, as good people. You get bureaucracy. Or if you had a, I don't know, mining company, normally you kind of mine out the best areas, the most, productive, or agricultural, you go and plant out your best fields, and you're not going in the valleys and so forth. So most businesses historically have always been subject to decreasing returns. But when technology came along, you start to get businesses, as they get bigger, they get better, the moat gets wider. And, the classic example is something like, Facebook, or, Google, or, even if you compare a business like, realestate.com, I mean, all of a sudden, realestate.com replaced, advertising, and they can own the whole market. So, most businesses subject to decreasing returns. As they say, Microsoft, it cost them $50 million to put out the first, copy of Microsoft, and the next one cost them probably 30 cents or something. So these businesses, as they get bigger, they get network effects. They don't use any capital, so they can scale. So these businesses can continue to grow, and they can defy what most people would expect them, because as they get bigger, the network effect gets stronger. It's very hard for people to come in and compete. Like, imagine trying to come in and compete with Google now. So these businesses are subject to increasing returns. So that's one. Yeah, I mean, other ones are businesses where you have markets, that the markets become, when Amazon started, people think books were their market, but in some ways that comes back to good management. Okay, we're in books. What else can we do? Okay, we can be in other products. Okay, by the way, there's this business over here we can start up called AWS. So, that really is management and culture, and maybe culture and management are the longest potential competitive advantages that there are. Because if you've got a culture of innovation and empowering your people and so forth, and trying new things, trial and error, willingness to make mistakes, you can get businesses that can last a very long time. So that's what you're really looking for, because ultimately if the business can grow at a higher rate of return than the market expects for longer, it's going to be a good opportunity.
And it goes back to what you said about your investing philosophy. You're trying to focus on finding businesses that are being valued at what they're doing at the moment, so the core business, but you're also trying to find businesses that have that optionality where they can essentially replicate their success, but in different avenue streams. And I think those are really good examples that you talked about, which reflect what your investment approach is. In terms of, I think building mental models is very important. I think not focusing too much on spreadsheets and focusing more on the qualitative aspects and reading broadly, and you do read a lot. So in terms of absorbing knowledge, how do you take notes? Is there any process or structure that you religiously follow?
I would say there's a process I religiously follow. I do try to read broadly, and I always, as I said before, I always enjoy an investor who I respect might recommend something is that's something that I'd certainly an investor I really respected recommended. Like, or I got hold of their book list, I might go down and order a few of their books and make the effort to read them. Sometimes I'll kind of go down a rabbit hole. I mentioned I've been reading, over the last 10 years, I've read a lot of company about great companies, but also about bad companies. I've read a lot about technology over the last, couple of years, trying to kind of increase my understanding or build out my mental models. Are really just a way of understanding the world, like having a good, something that explains something to you, like fighting the fade or scale economics shared. It's a mental model that helps you understand something that, it puts it into context. So you understand something. When you see it, you understand why it's happening. And when I read, I kind of write all over my books. So I tend to underline a lot and make little notes in the book. So I always got a pen with me or a marker when I'm reading. And then if I really enjoy the book, I'll either pull out some quotes and, I might post it on Twitter. I've got a Word document that's, it would be hundreds of pages where, like, quotes on certain things, and that's how Masters Invest started. Really, is just my collection of quotes on different topics. So I'll do that for books. So if there's stuff in there, I'll probably read and underline a heap of it, and then if I really enjoy it, I might write a post on it. So I've written a lot of posts. A lot of them are about books I've really enjoyed, and I try to in those posts I try to pull out the common factors. And a lot of Masters Invest really is, it's kind of a depository for where I can go back and reread things about businesses. And a lot of investing is pattern recognition. I think it's kind of understanding, looking at a business, why is it successful, where else could I find that, or what are some thematics. So that's really how I underline a lot. I do try to I try to read. I read stuff that I find interesting, and it's amazing. You find these ideas that you read these books, and then maybe sometime down the track something comes across that you see, and you're like, oh yeah, that's that. I've kind of recognised that. So I mean, a good example was I read a book on Patagonia, which is an amazing business in terms of winning in the ecosystem and the environment and so forth. And the CEO is very focused on the environment and taking care. Like if they've advertised like, this year don't buy a jacket, like get it repaired, and they'll repair. Like if you buy a jacket from Patagonia and it's it's got a rip in it or something happens to it, for the lifetime of that product, they will repair it for free. And you can take the product back to them, and they'll dispose of it in a thoughtful manner for the environment. And so I was kind of reading that, and then more recently I read the Dell book by Michael Dell, when he was talking about he had a realization that all of a sudden all these computers and monitors and keyboards were ending up in the dump with his dumpster and landfill with his name on it. And he's like, well, I don't think we can, I've got to now take, I need to be responsible for that. And then, I read the Dyson book, James Dyson, which was an excellent book. And he made the same point. He said, like, we're building this stuff, and it's like, we have to be responsible for, what happens to it at the end of its life. And so I picked up on those things, and it's almost like a connect the dots, right? And you start to see these thematics building, and then you might think, well, how can I get involved there? Like, is there a thematic? Is there a tailwind here? And in any investing, you're far better off having a tailwind than a headwind. We love businesses where there's some natural tailwind. So it's just little things like that you pick up in your reading that you can apply to your investments.
I like your example with Patagonia. I think when we chatted before, you talked about a book called Skin in the Game by Nassim Taleb, how a stubborn minority can impose its will on the relatively disinterested majority. And you kind of applied that thought process to Australian Ethical as an investment idea.
Yeah, that was probably, we talk about, how you come up with ideas. That was probably the main thematic behind our investment in Australian Ethical, was that we were at an inflection point where ethical investing, and we're huge believers in, and our type of investing is over the long term or medium to long term. If your ecosystem is not winning, so if your employers, suppliers, customers, society, community, the environment, if everyone's not winning, then you're unlikely to be successful over the long term. Like in the investments that we look at, we want the whole ecosystem, to be winning. So as a starting point for, if that's your type of investing, when you're looking for, the ecosystem to win, studies will show that, those assets are, long term will do well. So that's, as a starting point, it makes sense to, be focused on that. But I was reading Taleb's book Skin in the Game, where he talked about minority choosing for the majority, and I thought about it, and he talked about whether you went to a wedding and there was different people that had different food preferences, and so you rang your wedding planner and they're like, okay, who's got different food preferences? And you said, oh, I don't know, there's 200 people coming, and the wedding planner said, look, we can cater for these people. It's not going to cost you any more. The food's going to taste just as good, but everyone will be satisfied. And obviously you tick that box. that's the wedding you choose. So the minority has chosen there for the majority. So because the person says, oh, okay, well, there's 100 people and 10 people only want kosher food. So let's just make sure that it's suitable for everyone. So as I thought about it, I thought, like, if you were running you're running a mutual fund, and there's 1,000 members in that fund, and then 20 or 30 of them are really focused on the environment, and they're the people that are saying, like, say it's a corporate pension plan, and 20 or 30 people, and you're the manager, they're ringing you going, how come we're investing in these businesses that aren't good for the climate, that aren't good for people's health, that are polluting or whatever? You tell me that our business that that we own it doesn't do this, so why are we investing in all these things? And as the manager, you're taking a lot of heat from a small number of people about that type of investing. Anyway, someone comes to you and says, oh, by the way, Raymond, we can give you this, we can invest for you in an ethical manner that is going to tick all the boxes and keep all of your people happy. And we can probably prove to you over the longer term that it will outperform. And you say, okay, that sounds great. What is the cost? And it's like, well, the cost, it's not going to cost you any more than what you're paying. That's a simple decision for you to make, that's going to appease the minority, but the majority are no worse off. In fact, arguably they could be better off. So I saw that as we were at an inflection point. And then what happens is the people that are unhappy about it talk to their friends that work in a similar business. And then, their boss says, oh, well, by the way, I know Raymond, and he's investing this way. Why aren't we doing it? And so then social proof kicks in. And so they're the mental models behind, that idea that, hey, maybe we're at an inflection point. Maybe we're going to start to see, some significant inflows into ethical investing. Maybe this is going to take off. And then we did the work on the business, and it's got other characteristics that we like. So, it was really coming out of that, really out of reading that book and coming to that recognition that, hey, maybe there's an opportunity here. So yeah, I think behind a lot of our ideas, there's one or two core mental models, and then hopefully there's a lot of other little things combined, which together create the opportunity. So maybe it's like they've also got a great culture, they empower their people, they're radically transparent with their staff, those type of things.
Yeah, your last comments about people, staff, culture, I think when we chatted, you particularly emphasized one example, Les Schwab tires, which I think Munger covered, and it talks about how he implemented a really strong incentive structure that empowered employees, and that was very effective in growing the business.
Yeah, there's a book, Charlie Munger, and Charlie Munger himself is, one of the greatest students of human psychology, and more so than 99% of people. And he says, for a guy that understands incentives, even he underestimates their impact, right? Which is pretty unbelievable. And he talks about a book called Pride in Performance, about a business. It's about a guy who's now passed away called Les Schwab, who had a tire business in the US that was hugely successful. And you think about a tire business, there's not a lot of, this was one guy running, a tire business. He wasn't associated with Bridgestone or Goodyear, so he didn't really have any competitive advantages outside of people and kind of service. And Munger said, at one of the general meetings, he said, if you want to understand the power of incentives, then I'd recommend this book called Pride in Performance by Les Schwab. And as I mentioned, if someone recommends particularly of the nature of Munger or Buffett recommend a book, then I'm probably going to read it. Anyway, so I read that book about the incentive structure, and I was down in Melbourne, and we were meeting a whole heap of companies, and I met the CEO of this company that does work in natural disaster repairs for insurance companies, and it's basically a business which is made up of 30 or 40 very small businesses, where where they see an opportunity, they will go and pick a person, who they know or in another part of the business to and give them some equity in that small business to go and build out that business. So, you've got a person there that might own 10% of the company. Not 10% of the company, 10% of that individual little business. They're highly incentivized. They get funded into it. They probably get a dividend check every 6 months. Now, that person is competing with other businesses in that industry that are getting paid a salary and working 9 to 5, that have no ownership. So you're obviously going to get a situation where, you have this emergent behavior, which is very, very hard to compete against. So I remember meeting the company and I walked out for the first half an hour. All the CEO talked about was people. His motto is, we don't look at CVs. We hire for energy and integrity. And it's a bit like one of the great CEOs, Herb Kelleher from Southwest Airlines, said, train for skill, hire for integrity, or hire for integrity, train for skill. And that's their motto as well. So, we love these businesses that have something idiosyncratic about it in incentive structure that's going to mean that it's going to outcompete. It's almost like an emergent behavior that emerges from, the external parts of the business. It's not being directed from, the top or the CEO. It's like you've created this structure that gets people highly motivated. You encourage them, they're happy to go to work. Most people, 60 or 70% of people, don't like going to work. That's a statistic. Imagine having a business where 80% of people or 90% of people come to work and they love it. Like, you're going to win. Mm-hmm. So yeah, that was an example where, that was one of the main thematics behind, our thesis, was that, this business had a incentive structure and a partnership model, which was going to be very hard to compete with. And then you start getting, they had the benefit of national scale. They were much bigger than their next best competitor. We love businesses that are the leaders and winners. So these guys can advertise. They can go to insurance companies and say, we'll offer you products across the whole of, Australia, not just in New South Wales or Queensland. You don't have to deal. We can offer you the whole. And, that was a mental model I picked up reading the Copart book. So, and, in time you learn more about these businesses, and, the more of these mental models you have in your head, I think it's, it's more likely that you're going to find more, hopefully you're going to find more opportunities.
I love this approach where you're trying to build a mental model, trying to identify characteristics of businesses to help you find better investment ideas. There's another book that you mentioned yesterday. I think it's called In Search of Excellence by Tom Peters. And I got to say, I quickly Googled it, found it on Amazon. It's only $20 and bought it straight away. So,
well, that's a value investment, Raymond. I think it's a fantastic book. I probably read it not that long ago, maybe 3 or 4 years ago. I was reading from memory. I was reading a letter from an investment group in the UK called Lindsell Train, who, I think I would put them in the category of the Buffett Munger, Acray, Terry Smith. And they said that, and I had never seen this quote before, but they said that Warren Buffett said that was one of the best business books or the most insightful business books ever written. And so I thought, well, there's a book that I need to read. So it was written in about 1980 by a guy called Tom Peters, who was ex-McKinsey. He might have been McKinsey at the time. And it was basically a survey, and it's not the easiest book to read, but it was basically a survey of America's greatest businesses. So, what were the characteristics of these great businesses? And a lot of the things that they talked about are qualitative. And people can be, I know there's like books like Good to Great, and people would probably put this book into that. Some people would put this book into that category. It's like, yeah, well, those businesses weren't, they weren't all successful. And I think there's some limitations about business models and technology changes and so forth. But the businesses that were in areas which were not disrupted by technology, have very, very powerful business models. And, I've studied, businesses, like a lot of great businesses, Audi, Disney, Starbucks, Copart, Nucor, and what you find is that there's all these characteristics, and just like great investors, so many of them are the common characteristics that you find, and they're unconventional. And what surprised me was that those characteristics are no different, from 40 years ago, from in that book. So things like empowering people, treating your employees with respect, letting your employees make decisions, accepting of failure, encouraging innovation, being radically transparent, with your people. I mean, just a little anecdote. The other day, my son has got a job in a menswear shop, a clothes shop, and I said to him, he's only been there a month, and I said a month or two, and I said to him, how are you enjoying it? Tell me a bit about the business. And he said, oh, it's great. And he said, every week they send us a text message with all of the sales numbers from the previous week for the 15 or whatever stores. And he said, like we want to beat, I don't know, Hobart, or, we want to beat Hobart. Like, we can't believe they had a better week than us. Like, we're going to try hard to, beat the Hobart store. And I said, how does that make you feel? And he's like, oh, it's good. We're competitive, and like, and that's empowering. Like, that's, like, he's kind of gamifying it, like, having fun. That was another big thing in the book, having fun. And I said, well, how does that, make you feel? And he said, well, I feel like I'm important. They're happy to share this. I'm not sure they should be sharing this information with me, but like, it's, so he's made to feel like, they trust him, they respect him, they value him. And by the way, here's the numbers. And great businesses are very transparent. Like, it's one of the things I found. They share the numbers, they put them up on boards, they give people goals, so it's, what was uncanny was just all these characteristics that when I read that book, and, all the businesses I've studied, not just, in the last, but business has been around for a long period of time, you find these common characteristics. So, I hope it's not an easy read, but I hope you, I hope you enjoyed it. I certainly, I think in the website, probably in the other reading, it's probably the #1 book.
Okay. Thanks for the recommendation. So just going to move away from books and wanted to, something that you've been spending much more time on. You've been diving deep into technology, so reading a lot of concept papers, journals. I think you've mentioned them before, the likes of Brian Arthur, Andy Grove, Carlota Perez. I think one notable example that you mentioned was the one who wrote about the future or potential destination of Facebook, and they were spot on.
Well, I think of those, as I said, I've kind of been down that rabbit hole over the last year or so, reading, Brian Arthur I came across from the Santa Fe Institute. I mentioned that piece that he wrote, which, geez, I wish I'd read that in 1996. I would have understood, what great businesses, the FANGs were and what they could go on to become. Andy Grove ran Intel, talks about like inflection points. Carlota Perez, his book is on, I came across that book. It was recommended by James Anderson of Bailey Gifford. It's an unbelievable book on, technological revolutions. And, I'd read before, about the history of railroads in the US and how it, opened up America really from, places that just weren't even on the map. All of a sudden you had this massive interconnected network, and, businesses thrived. And it reminded me, a lot about what's happened opening up the world with, technology and the internet. And that book goes through and talks about, kind of technological revolution. So I think it starts with railroads, and then, does things like the telephone and mass production. And then it was written in 2000. And then she talks about, basically you start with a kind of a frenzy and a bubble, and then you go through a difficult period, and then the technology gets diffused through different types of industries and different geographies. And, she basically said, look, she wrote it, I think after the tech crash, she said, like, this is kind of like just the starting point for these, technologies that have been created. A lot of capital obviously went into, that's one of the great things about, you have this massive boom, and you get this capital that's lazy because it's in old industries. It's just thriving to find something, more exciting and higher returns, searching for higher returns. So you get this massive frenzy there's so much capital and such little place to go. So you tend to get bubbles, and then you get this crash, and then after that you get the diffusion. This is multi-decades. And when you read it, it's like she's, looking back on it 20 years, I mean, she's been absolutely spot on. So, I think having an understanding of, like where the world might be going. Another great book I read was The Platform Revolution, to understand what makes great platforms. That was a very good book. Brian Arthur's stuff on increasing returns. Yeah, I think, once again, it's just kind of building out the mental models and understanding of the, of the world that, hopefully helps us, identify good investment opportunities.
I think I'll be interested to find out whether or not you're reading any concept papers or journals about blockchain technology, which seems to be a very strong thematic recently.
I haven't, but I can understand. Like if you read the Carlota Perez book, it helps put into context what's actually happening. So I can definitely understand what's happening, and you can build out a framework for where we might where we might end up, right? So there's all this lazy capital. It's looking for higher returns. There's one place you can put it to begin with. Maybe that's Bitcoin. With all things investing, then when something's successful, one of Wall Street's greatest tricks is coming up with 20 other things that look the same. You can understand. I can understand the conceptual framework, and then maybe obviously we've had some crazy stuff with NFTs. But you can understand that there's going to be a lot of capital that goes into the blockchain, and the world is probably going to be different. We don't know how it's going to end up. It's hard to, from my perspective, would I invest in, we try to buy businesses where we think there's intrinsic value. So I'm not sure I can get to a point where I think there's intrinsic value in the cryptocurrencies. Does that mean that you shouldn't own any of it? Well, not necessarily. If it's highly asymmetric, as long as you can tolerate some losses, then it might make sense to own 1 or 2% of it in your portfolio. But I do think that you're going to get to a point where yes, all of that technology is going to diffuse itself and find ways that we can't even think about now that it's going to be useful. And one of the things I have learned in investing is over the years of experiences, when you have a very strong negative view on things, often it is that you just don't understand it, right? So it's easy to sit there and say, I'm sure it was easy to say Tesla, was ridiculous when it became bigger than General Motors or bigger than Ford. And then, it becomes ridiculous when its market cap's bigger than every auto company in the world. We have such limited knowledge, and things that are innovative and new and at the edge, it's very hard. Like if it was that easy to understand them and where they're going to be, then, we would have come up with them before. So, I don't like betting, I wouldn't go and bet against those things. It's not the type of investing that we do. But I do think having that framework and reading the Carlota Perez book, there was another good book recommended by one of the Tiger Cup guys, Philip Lafont, called Engines That Move Markets. Similar type of thing about understanding the history of he talks more about individual kind of companies and performance and so forth. But yeah, I think understanding history and understanding technology and how it works as well. Carlota Perez's book is fantastic.
Yeah, I think that's a very, very good approach to view the Bitcoin and the cryptocurrency and blockchain space, and trying to understand how the world looks like by using those frameworks. And on the topic of frameworks, you mentioned previously that it's not easy, but it's easier to mimic the great investors' investing style of trying to find high quality businesses that compound at high rates compared to your macro and your trading strategies. But I think one thing I took away from that comment was that it might be easy to replicate the strategy. And you've mentioned this before, but it's much harder to have the emotional and psychological mindset to play that strategy out. So I think it'd be great to talk about, the key traits and also potential biases or pitfalls that a great investor needs to acknowledge and also work on over time to become a great investor.
I think you need patience as an investor. And I think you need to recognize that you don't need to get rich quickly. The power of compounding is is so extreme that, and you know, we talked a bit about cryptocurrency before. You know, the challenge with you know, it's easy to go and look at something and say, geez, Bitcoin's been a great performer. People like to buy things after they've already gone up. Like, I'm not sure where Bitcoin, you know, I mean, I have no idea. I don't think anyone knows where it's going to be. So it's hard to underwrite the future, you know, in that. And there's no, what I would say is, you know, really intrinsic value. If you buy a business that's spitting out cash and profitable, then, you know, you can get your return out of the underlying returns, you know, from the business. It's investing. It's not speculating. So I think, as I said, like, you don't need to make, you know, people are in a hurry to make returns. You know, Buffett's, you know, got the best long-term track record. He's done 20% a year. So people thinking they can buy crypto and triple their money in a year, like, yeah, I'm sure some people have done that, but I'm not sure it's a path to long-term wealth creation. So I think, you know, what I would say about investing is be patient, try and find high quality businesses. I think that's, you know, I think that's the best hedge for, you know, long-term returns against, you know, I mean, just think about COVID. The guy from Andy Grove from Intel said, bad businesses get destroyed by crises, good businesses survive them, and great businesses, you know, are made better by them. And I certainly think that's, you know, that's true. I mean, if you think back, you know, about, you know, any businesses really, I mean, like, you know, we've had a stress test, 1 in 100-year flood in the last, you know, 2 years, right? So I'd kind of argue in some ways that the businesses that are around today, you know, have been proven, and maybe they're a little more valuable. So I think they're the kind of the key points. Understand what you invest in, understand that markets are going to be volatile. You are going to take some drawdowns. That's just the nature. It doesn't matter what stocks you own. If the market goes down, you know, ordinarily nothing's immune. Focus on the destination. You know, they're the key points that I'd make. Like, minimize downside. So you're going to have to be diversified. Understand you're not always going to be right. People make mistakes. You can't possibly know everything. It's just not possible. So, you know, if you take on those traits I mentioned before, try to think about those. You know, the markets are the stock market is, you know, people think it's risky, right? But when you think about the long-term returns, you know, the stock market over the long term's delivered 10% per annum. The Reserve Bank of Australia put out a great paper a couple of years ago looking at the long-term returns. Now, the Aussie market, I think, on average has done 10% per year. You've obviously had, this was up to 2019, so you've had, you know, World War, Great Depression in there. I think it was just after the other pandemic that we had in, I think it was 1917. But you've had all sorts. You've had trade wars. You've had massive inflation, and yet the market still did 10% per annum. Over that period of time, the bond market did about 6%. So there was a 4% differential that stocks did. And if you put $100, I think in 1917, into the stock market today, you would have $2 million. If you put it into the bond market, which did 6%, so only 4%, it's only a 4% differential, you'd have $46,000. So you made about 43 times more money investing in the stock market. But, you know, you can't invest in the stock market if you want the money next week, or if you think you're going to make, you know, 20% in the next 6 months. It's just not going to happen. You have to be patient, and you have to take a medium to long-term view. You know, I think what we've seen and the drivers of that long-term 10% return, I think, are still very much intact in terms of, you know, capitalism works, high levels of innovation, et cetera. So that's kind of the key takeaway that I take out of it.
Having gone into the buy side and then running your own fund, is there any way or process, structure that you use to keep track of your psychological mindset and any biases that might creep up? Or
well, one thing that I do when we're investing is, or people ask me about stocks, you know, I tend to say to them, look, this is my view on, I think it's a good company. These are the reasons that we like it, but but I might be wrong. And so I think giving myself that ability to recognize that, you know, I might be wrong is going to make it easier for me to change my decision if I get conflicting information. So, you know, and, you know, always kind of seeking out that kind of information that's contrary to your view, but Where people, I think, get into trouble is where they're absolutely adamant that this stock is a buy. It's it's not possible. It's a fine balance between confidence and humility. To realize that hey, you might be wrong. So one of the strongest human biases is commitment and confirmation bias. That we always think we're smart and we don't like to admit that we've made mistakes, and we seek out information that's confirming. And people might write a negative story about a stock that we that we own, and we probably just dismiss it and say, oh, what they know. So I think that's important. You've got to be open-minded enough to recognise. So that's one of the. I think that's one of the little hacks, I suppose, that I use to make sure that I'm not falling in love with stocks that we own.
Yeah, I think personally, I find it easy to fall in love with the stocks that I own, because every time I see a positive comment on it, it kind of releases these endorphins. So it's hard one to keep manage of, I guess.
Oh, that's human nature. It's we unfortunately we're wired that way. We're wired to be fearful and greedy, and that's come from millions of years of evolution. We haven't evolved to be good to behave correctly in different stock market cycles.
So I think this is a very important question, and I've asked this question for all my guests, and it's who's had the most influence on your development as a person and as an investor, and why?
Well, I don't think there's as an investor, I don't think it's any individual. Certainly I've probably learned the most from Charlie Munger and Warren Buffett. Not in just investing, but in terms of how they conduct themselves in life, and listening to their theories about life in general. And as I said, I've kind of read all the Berkshire letters and studied the Buffett partnership letters prior to that, and I've spent the time to go through and kind of study the Berkshire meetings, where you get a lot of kind of questions about all sorts, like the unscripted questions about, I don't know, franchises and whether you'd invest in these type of companies. So as an investor, I've learned probably the most from those guys. But as I said, I've also taken a lot from all types of investors, like building out the mental models. Over the last few years, certainly, my partner is, she likes pushing me outside of my comfort zone, to challenge myself to do things that maybe I'd be, less inclined to want to do. So yeah, she's been, she works in technology, and she's pushes me to, like, hey, you need to look at these, why aren't you looking at all these technology stocks, and the world's changing, and so and just kind of pushing back on ideas and theories, and that's what you want. Is you want people that are going to test you, people that have diversity of opinion, people that I think are high quality, all of those, and Buffett and Munger says, associate yourself with the people you want to be. I think that's great advice. So yeah, hopefully that answers the question.
100% agree. I think it's really fortunate that you have great people beside you, especially your partner. I think it does help a lot when you have people who push you to be better, not only as an investor, but also a better person. So we've talked so much, and I'm really privileged and grateful to have you on the Australian Investors podcast. I think the listeners will listen to this podcast more than once. I definitely will be re-listening because I think the insights that you provide, not only from your work experience, but also your knowledge about the great investors, all the books that you've read. And I think the Australian investing community is very fortunate and lucky to have someone like that, someone like you, to share all your knowledge. So thank you for coming on the Australian Investors podcast, John.
Thank you, Raymond. You're too kind. I really enjoyed the conversation, and if people want to, access the the website, as you mentioned, it's mastersinvest.com. You can join the mailing list, always happy to, get feedback and hear from people and thoughts and so forth. So, it's been a real pleasure chatting. I've thoroughly enjoyed.
I think your Twitter handle is @Masters Invest. Is that right?
Yeah, that's the one.
Yeah, that's right. Hopefully speak soon, and good luck with the rest of the journey.
That's great. I appreciate it, Ryan.